We're back. Let's do Ask Annex. Matt Morzy in the studio as Director of Research and a CFP. Hey, Matt.
Hey, Danny.
And Fred Coleman, Wealth Manager and a CFP at Annex Wealth Management. Welcome back.
Danny.
Ask Annex, question number 1. What do I tell my Gen Z granddaughter who is positive Social Security will be gone by the time she retires? She actually seems somewhat irked at me since I represent boomers. Welcome to the club.
Yeah. You can't get mad at grandma, but I think it's impressive that someone that young, talking about probably in your 20s or even in your teens, thinking about Social Security. I definitely wasn't thinking about it at that age, but what I would say is just to encourage her to start saving as much as possible right now. Because there is a big chance that, 40, 50 years from now, Social Security is not going to be the same as it is now. There's going to be, some type of adjustments. Likely will be some form of Social Security, but we don't know. So if she starts saving right now, there's a high chance that she won't have to rely on Social Security. And what I tell, Gen Z, millennials, everyone at that younger age that's worried about it is if it comes, great, but put yourself in a position where you've saved and invested enough where that you don't have to worry about it. And if it comes, it's just a bonus to you.
You got little kids, too. What generation are they? They're Alpha? Is that Alpha?
I've ran out of, I don't know what the letters are anymore.
How about you, Matt?
Yeah, when I think about stuff like that, I think you're spot on, Fred. Social Security, when it was created, was never designed to be a retirement savings plan for people. It was a thing for people to fall back on. And I think that's how we need to look at it as well, too. So we save in effort to not be able to need to have to access that at all. And if it's there, awesome. That's great. But plan as though you're not going to have these things. And that's really how I look at planning in general, just on anything, even if it's not Social Security, is you do what you can do. You try to maximize what the things that you can control and what you can handle. And if something else is there, before it was pensions, almost everybody had a pension. And now, the numbers are a really small amount in terms of what people have access to that. So you plan as though you're not going to have those types of things. And if it's there, awesome.
Next up on Ask Annex, my wife is worried about world events. She's suggesting we limit our investments to U.S.-based companies. I think that's nearly impossible. What are your thoughts?
Yeah, it depends really on how you're going to put those things into different criteria. So when you're thinking U.S.-based, does that just mean that the company is domiciled here in the U.S., or does that mean that their revenue is only U.S.-based revenue? Because that's going to be really, really rare. A lot of those are going to be really small companies that are only specifically U.S.-centric. If you look at the different indices, the Russell 2000, which is a small cap index, tends to be much more domestic, less exposure overseas. The S&P, you're looking at 60% of the revenues made in the U.S., 40% is overseas. So even if you said, I'm going to buy a U.S. index of only U.S. companies like the S&P 500, you're still getting 40% of your revenue from overseas. So really trying to put yourself onto an island, is really, really hard. Now, from a performance standpoint, we get this question all the time, and it's one I've heard really recently is, why do we even invest in international companies at all? And it's easy to see that since we're in a 15-year bull market for U.S. stocks compared to international, but the 15 years before that, it was the exact reverse. So from a diversification standpoint and trying to limit risk, you might think you're taking on more risk by investing in international companies, especially when we think that geopolitical issues are on the rise. But realistically, you're actually lowering your risk and giving you a higher expected return long-term by adding that diversification in of having international companies. So although headlines seem bad, they always do. You can go back into any single year, look at the headlines, and you can find reasons to have been scared at different points and think that the world is going to end or think that we're going to be going into a major conflict. But that stuff happens all the time. And really what you want to do is put the math behind it to work to lower your risk and have a better expected return.
Yeah, and that's one of the things I appreciate about Matt and the investment team is not having that recency bias, like really taking a long-term approach. Hey, if international is a better investment right now based on the research, that's what we're going to do. Not just looking at what's happened in the last 15 years, looking at it as a total picture.
Final question on Ask Annex. Who can invest in alternative investments? Do I need a certain asset level? And, we have a lot of interest from our clients in this. We've done some webinars on this, but what do you think, Matt?
Yeah, we certainly do. It's a question that comes up a lot. And yeah, there are some minimums that you have to have. And essentially the background to that is that, our regulatory bodies in the U.S. phrase different minimums in there in order to minimize risk for people who might not be sophisticated enough or have enough investment experience or to understand what they're getting into. And where this particular alternative investments is that they're generally illiquid or have very low levels of liquidity where you might not be able to get all your money out at points. You might have to wait a year, 5 years, 10 years, depending on what some things are, or you might have to take a haircut if you need to take money out. So with that adds in a lot of extra risk with having that illiquidity built into it. So they do put some minimums. So the most common one, or what people really worry about, is what's being called an accredited investor. And you need to hit one or two different criteria to do that. You either need to have your net worth be over $1 million. That can't include your house. So it's got to be essentially $1 million that's liquid. Or you need to have annual income of over $200,000 for yourself. Or if you're putting in joint income, then it's $300,000. So those are kind of like the main criteria that we look at. There's some other things that get added on to that, or maybe some variables that could change to that. If you work in the industry, it's a little bit different because you have different certifications, you have different investment experience. So sometimes there's ways to be underneath those levels. But for most people, that's usually what we're looking for.
Yeah, and those are put in place to protect people. That's the bottom line.
Fred Coleman's a wealth manager, CFP at Annex Wealth Management. Thanks.
Thank you.
Matt Morzy, Director of Research, also CFP. Thanks.
Thank you.